They were going in with 100% financing and were given these like ridiculously awesome introductory rates that just ballooned, and that's basically what ended up hurting them. In one of the previous episodes, I have talked about the difference between multifamily and single family. And I've touched up a little bit on the loans and the lending and kind of how that works when it's residential, when it's commercial. And today I wanted to get a bit deeper into that and just really focus on the loans and talking about the differences between the commercial loan versus residential loan. Now, as we have mentioned before, but we're going to remind folks, just in case you didn't watch or listen to the previous episode, when we're talking about residential, we're talking about 1 to 4 units. Commercial, we're talking to 5 units and up. So that's where the difference really comes in when it comes to the loans. They look at the number of units, the number of families that will live in this particular object, property that you are purchasing. If we're talking about land, for example, that is going to be a little bit different. And depending on the size of the land and the purpose of it, you may or may not get a traditional loan, meaning from a bank. Oftentimes, for residential plots only, banks will not want to lend money for just land. They actually want some sort of structure with it, but it is not unheard of that they have done it in the past. You just might need to do a bit of a shopping, if you would. The cool part about the residential piece is that you can typically borrow, it really ranges from what you can get. Now, your conventional loan is going to be 20% down and 80% borrowed. It's also known as 20/80. However, there are the 1090 as well that sometimes will fall under this, 595 as well. Then you have the FHA, which is 3.5% down, and that would make it 96.5 on the other end. And then there, of course, sometimes 100% financed, meaning zero money down. Now, when we talk about these, that's kind of where the difference is. When we are, for some of you that have been maybe hearing about like the financial meltdown of the 2008, right, and sort of what happened with mortgages and home prices and all of that stuff. Vast majority of the challenges were that folks that were given ability to borrow money to purchase homes didn't really qualify. I mean, they did qualify. It was just a made-up number. They were going in with 100% financing and were given these like ridiculously awesome introductory rates that just ballooned, and that's basically what ended up hurting them. There were other issues that were happening, but that's kind of how it started. So the FHA is the 3.5% down for in United States. That's for what they call the first-time home buyer. That doesn't mean that you have to be a first-time like ever, like you have never owned a home ever, but it does have certain stipulations of what you can and cannot do, and it has to be your primary residence. So you can't use FHA for investment property unless you get creative and you decide to get 4 units, right? Because it will work for 1 to 4 units. You get 4 units, you live in one, and you rent the remaining 3 units. And if you do it well, magic happens. So I'm actually going to cover in one of the upcoming episodes or one of the previous episodes, depending on kind of how this is released, but there will be a video where we talk about sort of what is known a little bit as house hacking. So we'll talk about that and kind of how that all works. But anyways, just something for you to keep in mind of what this is and kind of how it works. The traditional conventional, this is what's going to happen, and typically you can count on 20% down being something that you will have to put in for investment. Now, a few years back, I was looking and considering of investing in a single family home in Arizona. So it's a Phoenix area, not Phoenix itself proper, but Phoenix area. Phoenix area is actually metropolitan area, is quite a few different towns, if you would. So for folks that are from there, you understand exactly what I'm talking about. And I was looking at doing that stuff, and because they were so overwhelmed with the amount of investors going in, the lenders were looking at 25% down, 75% financed. As crazy as that is. So I was like, wow, that's really interesting. So don't get surprised when you see that sometimes for investment, they will ask more money because they see it as a higher risk. So just something for you to be aware of when you're going out there and shopping for your loans. But these are the typical and basic components of kind of what works within these. The rates at what you can get it will vary a bit. So you can look at, typically they will follow things like LIBOR, which by the way is going away. So they're going to have to come up with something else. Prime rate, US prime rate is another one they will follow. So depending on what the bank follows, it's going to fluctuate and be differentiated between. But you know, if the homeowner is 3.5, investor might be like 3.7 or 4. So you can always count on investor having to pay a bit more in the money. So sometimes you have to put down more money, and often you will have to pay a bit more to borrow that money. And one of the things that it's going to do is just it's different, and it's going to be based off of your credit score. So your credit score is going to play a huge part when we talk about the residential loans over here. And finally, the piece that you remember with residential loans is that the qualifier is you, the investor. You, the investor, your income and what you bring in is what's going to qualify you for these particular loans. Now, we're going to jump on to the commercial loans. Commercial loans are 5 units and up, and typically it's going to be, again, 20/80, meaning 20% down, 80% loans. You will also see 25/75, quite a bit over here. Sometimes you will even see 35/65. Occasionally you can actually get 0 down and 100% financed. And very rarely is it going to be that 5 to 10% down, or 90 to 95% financed. So these are the most typical. These exist but are not as prevalent. Now, there are different things that you can do with the commercial that you can't do with residential, for example. So you could much easier potentially find partners that can help you with some of this down payment, and then the rest of it you can borrow from the bank. The commercial will be typically on the 10, 15, 20-year loans. For smaller things, sometimes 25, 30, 35, and even 40 years for the borrowing of the money. The part that is kind of cool about the commercial loans is that it's not the person that qualifies, but rather it's the building itself. So they will look at making sure that building income can support the loan that you are trying to get. So while residential is qualifying the person, commercial is qualifying the building, which makes it pretty cool, so that even if you have horrible credit, they really don't care that much. They want to make sure that you have experience investing in real estate, managing real estate. So starting in residential may not be the worst idea on the planet, even if you want to go commercial, but you don't always have to. Sometimes bring in a partner who might have experience, sometimes showcasing some stuff, sometimes being willing to pay a bit more money. They will allow you to do that. So don't worry too much about that stuff. Another piece that you also want to think about with commercial loans is that rates are going to be a bit higher, just like for the investor on the residential side. Rates are going to be a bit higher, but again, it really depends on the size of the property, and you the investor. So the more often you're doing these, as you get better as an investor, you will start making connections with the commercial loan officers, and you will start getting preferential rates. So your business is going to start getting credit rating, if you would, and that is going to help you get some really, really cool rates that sometimes actually beat residential, if you can believe that. So just another thing to really consider about when we're thinking comparing the two different rates. Final piece that I do want to talk about is that there are things called recourse and non-recourse loans. Recourse loans basically means is that, and typically you see that in residential, it basically means that if I don't pay my mortgage, I will lose my house, and potentially the bank can go and sue me and try to take other possessions away from me. So that might be a car, that might be my secondary home, that might be my whatever, right? So that's what the recourse means. Non-recourse means is that if I borrow money for this particular unit or this particular project or this particular whatever, and I get a non-recourse loan, it means that if something happens where I'm no longer paying the mortgage on this particular building, the bank will foreclose, they will take that building away, but they will not go against me personally to try to recoup the differential, if there is any, if I end up owning more than the building is worth. So that's where the difference is. Whenever possible, on the commercial side, shop for non-recourse loans. And of course, depending on the size of the loan will depend whether you're able or not able to do that. On residential side, you can't even ask for that. So just go with whatever they give you, because they won't offer that. It doesn't exist on the residential side. It only exists on the commercial side. So those are some of the really key components that I think are important for you to know and understand when we're comparing the two different loan types that exist out there. One final piece with the commercial is that there is a minimum typically that folks are willing to lend, and most of the commercial lenders are looking for 1 million and up. Most of the preferential rates and kind of like the cool things and that whole like 40-year loans and that kind of stuff, and sometimes even zero financing, you're looking at 10 million plus. So the more money you're putting in, the better off you're going to be with the commercial loans. On the lower end, typically you can get a commercial. It's rare, but you can get a commercial as low as like 200,000 plus minus. But you're going to have to shop with local, smaller regional banks. You're going to need to look for credit unions, for example, that might be willing to lend for the smaller things. So what I have found is that on the commercial side of things, lending is much easier than on residential, because you qualify in the building and it's really, you fill out a few forms and you are done. Whereas residential, it's like months of like everything from like your W-2s and like your savings accounts and like all this crazy time. We're like going back and forth, back and forth, back and forth, back and forth. On the commercial, they were like, just send once and you're done. So that's the cool piece about it. And what I have also found with the commercial is that it's the more expensive the property you're buying, the easier it gets to borrow money and it easier gets to find other investors. I hope this was super helpful to you. Until next time, stay forever money blessed, and do remember, you are only one deal away. I want you to be happy. Don't you want to be happy? I want to be happy.